And one of the hot questions that I get asked regularly as well is how can landlords minimize their tax on property? So we've had a lot of changes in legislation recently regarding being able to deduct the interest on a mortgage. So is it better to buy a property as a private individual or within a limited company instead?
Well,
very often there is an assumption out there that once you become a homeowner and then later on you sell the property, you return back to the status of a first-time buyer. Is that true? In your experience, what are the top 3 things that investors tend to overlook? So as you will be familiar right now, is flipping properties has become really popular, especially amongst the younger crowd as well now. So what would be the tax implications of flipping a property versus keeping it as a long-term investment right now? What are the key tax differences and implications between residential and commercial? Hi guys, it's Zahid here from Abbey Property, and you've been asking me loads of questions regarding property and taxes. So I've got a qualified accountant with myself today to go over all of your questions that you've been asking me. Andrew, tell us a little bit about yourself.
Very pleased to meet with you today, Syed. I'm Andrew Davis. I'm a qualified chartered certified accountant, also a qualified IFA, and also a probate practitioner. So very pleased to answer your questions.
Andrew, let's have a seat and get started with the questions.
No problem at all. Let me do you. Yes, I'm a qualified chartered certified accountant. I'm also a UK and international tax specialist. And one of my other specialisms is property. So I'm very pleased to meet with you.
So Andrew, from your experience, what are the top 3 things that investors tend to overlook when they are investing in a property?
Well, the things that strike me firstly is they miss out capital allowances. And that comes in when you're in commercial property. Second thing is they miss out things like entrepreneurs relief when they're using the building as part of their business. And the third thing is when they can claim relief on the actual replacement of items such as furniture or equipment such as washing machines. So very simple things sometimes can bring a big answer.
What sort of things qualify as deductions?
Well, I think the most important point is that keep records, keep evidence of receipts, keep evidence of payment. And the first point here is simple things such as keeping organised. And allowable expenses include the maintenance, repairs and things like this, and getting deductions accordingly. But if you don't have the actual invoices to support them, you won't get relief.
What do you think someone can do to quickly record their documents?
Well, simply recording is firstly keeping a record. You could put it as simple as keeping a lever arch binder, but we as a practice tend to prefer using software and where the person scans the invoice in and they can keep a record.
Right, or like a quick picture on the phone just to keep a record of it.
Yeah, and this software allows you to take a picture on the phone, scan it into your phone, and then upload it into the software.
That way you're not missing anything out.
No, and the point here is, if it's disallowable, well, you can have a look at it and see what the invoice actually said.
So we've had a lot of changes in legislation recently regarding being able to deduct the interest on a mortgage. So is it better to buy a property as a private individual or within a limited company instead?
Well, I think this goes back to my comment to you in the sense you have to look at the aims and objectives of the client. Why are they entering this process? What is their goal? What are they aiming for? Because from the practical point of view, the company, if it's used as a company, can get full deduction for the interest. However, there are disadvantages of running a company. Not major, but there are disadvantages. You've got to file accounts, you may be paying a slight premium on your interest and things like that, and you've also got money locked up in a company. But the other important point here is the interest that's allowed for an individual is most restricted, particularly with higher rate taxpayers. And when you start adding on income to existing income, you may even go to the extent of losing your personal allowances because your income's too much. So there's lots of things to think about. And that's where you need probably a little bit more tailored advice.
Right, so you would say reverse engineer that. First of all, have a look at your goals, your objectives, sit down with a qualified accountant and then say, look, this is what I'm trying to achieve.
Absolutely.
Where do you think I should start off in the beginning? Reason being is because later on in the future, it's a lot more difficult to reverse all of that.
Reverse engineering is possible. However, you may end up with capital gains tax, you may end up with stamp duty. Things like that can happen. But the main important point is to find out what the aims and objectives are.
Right from the beginning.
Right from the beginning. That's the first conversation we have with a client that comes to us saying, I'm interested in buying a property. Because if the objectives are different, then the formula will be different to actually get them the right answer.
So as you will be familiar right now, is flipping properties has become really popular, especially amongst the younger crowd as well now. So what would be the tax implications of flipping a property versus keeping it as a long-term investment for rental instead?
Well, I think what people don't realise is that HMRC will take a flipping operation that's done very regularly as a trading exercise,
Right.
not a capital gain. And the problem there comes, it can apply to all different industries, but particularly property. If someone flips property left, right and centre, you can end up with a situation they've got themselves what we call trading income, which is not the same as capital gains, and the rates of income tax would then apply.
Right. So on that one, there would be higher rate, or?
Well, it would be higher rates, yes. From the practical point of view, you pay income tax.
All right.
And if you've got an existing income, that means you're going to have some serious liabilities, could be 45%.
Would there be a definitive number when it comes to too frequent, or is it a grey
No,
matter?
you need to show what you're doing. You need to have the right. This is like presenting a shop front. The shop front has to be laid out properly. If you're, for example, living in a house, doing it up and then selling it, well, you'll probably want to claim main residence relief.
Yep.
But the point there is you have to show it as your main residence. That's really important. If you're just buying a flat here and there and then flipping them over, doing them up, you've got a trading operation. So the whole thing is you need to speak to a qualified accountant to make sure what you're proposing
Yep.
fits into whatever category. Because the worst thing you can do is do all these, make lots of money and find the tax liability isn't what you thought it was.
So you need to get your intentions clear right from the beginning,
Absolutely.
and
yeah.
then figure it out if that's the right path for you to be able to
Absolutely.
take.
And from the practical point of view, it's so obvious, but very often many people ignore it.
Andrew, in terms of capital allowances, how can investors take advantage of that when investing in a property?
Well, firstly, capital allowances are normally associated with what I call a commercial property.
Right.
It could be mixed use, but it's mainly a commercial property.
Okay.
And we've dealt with situations like hotels, for example, where the capital allowances are very substantial,
Right.
and these give immediate tax breaks. So never ignore the capital allowance question, and always ask that question.
Right. What about when it comes to residential?
Residential, more limited, because you're dealing with the asset removal, so there's no real capital allowances involved,
Right.
or not substantial enough to warrant a conversation.
Right. So that's mainly when you're dealing with commercial.
Commercial or
property.
mixed use. In other words, you've got a doctor's surgery with a house above, something like that, or you've got a shop with a flat above.
Yep.
But the point there is that capital allowance is important conversation point.
Right. So whilst we're on the subject of commercial already right now, what are the key tax differences and implications between residential and commercial?
Okay, well, firstly, VAT, value added tax. People ignore it at their peril. If someone has opted for tax on a building, that opting for tax lasts for 20, 25 years, which means any rents are chargeable to VAT.
Right.
Second point is, you may find selling the property, you can't charge the VAT or recover the VAT, you have to pay on selling the property. So the point here is you firstly have to decide whether the commercial property should be VAT registered. We dealt with a case not that many years ago, an industrial unit, there was about 20 odd buildings. One of the buildings burnt down. The building cost 200,000 to replace. The VAT was a substantial number. All the traders were VAT registered. We had to opt the buildings or the land for VAT. Therefore, they could recover the building VAT.
Right.
So every case is different, but opting for tax is the first point. Second point is what they're going to do with the income, how they're going to achieve it, and do they really want to own it personally or do they want it through a company? Commercial properties very often can be owned through a company, and these are single purpose vehicles, i.e. you just have one company, one property.
It's for that specific purpose.
Yep. Because what you can then do is sell the shares in that company to another investor.
Right.
We've done a number of these, like with hotels, for example. The hotel is actually owned by a company. The investor in Jersey or Guernsey will buy the shares in the company and therefore only pay the stamp duty at share rate, not the stamp duty at the value of the property.
Right.
All these considerations come into play, and the commercial property has the ability of generating a more steady income than residential very often, because you have a lease or a license. The disadvantage with it is that you may have higher repair bills.
Right. Right. So I'm guessing this is exactly just like the same as the previous stuff that we discussed as well. Getting it right from the beginning, getting your
Absolutely.
intentions in place right from the beginning, and making sure the structure is set up in the correct way to make it the most tax efficient later on as
Absolutely.
well.
We have a number of clients that come to us, they've been to an auction, I bought this.
Yeah.
And there was a case in Luton, someone bought the car park that used to be the police station on Stewart Street.
Right.
And the situation there, they turned up at the auction, they were from Jersey. Oh, that looks okay. They put the hand up. They won it. And the point there is suddenly they've got themselves a car park. Well, car parks are standard rated for VAT.
Right.
They cannot fall outside of VAT. So all those considerations come backwards.
Yes.
But the point there is always start from the end,
Yep.
then re-engineer it from the start.
Right. Keep the end goal in mind.
Absolutely.
When it comes to stamp duty land tax, what are the main sort of ways an investor can reduce their tax?
That's very difficult because stamp duty land tax has become more complicated by its nature. The situation there is don't forget the first-time buyer situation,
Yeah.
but an investor very often has already done that anyway. But multiple occupancy is the main game, where they've got multiple occupancy present premises. They can take advantage of some stamp duty reliefs.
Right. Very often there is an assumption out there that once you become a homeowner and then later on you sell the property, you return back to the status of a first-time buyer. Is that true or not?
I would say no. The first-time buyer is what it says on the tin, first-time buyer.
Right. So even if you sell your property, it doesn't bring you back on the status.
No.
It's a bit
You
of
can try. No. We get a number of solicitors that ring us up and send their clients to us. Oh, can you work out the stamp duty? We say no, solicitor must do that. Because he's got all the paperwork, he knows all the transaction, and they're just trying to dodge the bullet.
okay.
But it is a complex area.
Especially when it comes to not wanting to pay it.
Well, there's only two things certain in life.
Yes.
That's called death and taxes.
Exactly. So, Andrew, you've been dealing with a lot of foreign investors as well, from what you mentioned. So how does the UK tax system impact them?
Well, firstly, when they receive rents, they either have a registered agent in the UK, which can be an accountant or it can be an eligible estate agent, who basically says, I'll pay the tax if you don't pay the tax. And then they get the payments made gross.
Yep.
If they don't, then the tax is stopped at basic rate.
And what about the NRL1 form, which is the non-resident landlord form?
Well, basically, that has to be completed anyway. And very often, because the property is situated in the UK, they'll still need to file a UK return.
Right.
So the fact they've filled in the NRL1 form doesn't obligate them or doesn't stop them from actually having to fill an SA return in.
Okay. And in terms of, for example, when it comes to the transfer of rent, right, can the agent transfer the landlord the rent once they fill the form in, or even after that they still have to be liable for dealing with the taxes?
Because the obligation is on the agent,
Yeah.
the agent takes on the responsibility of paying the tax.
Right.
So effectively, the tax will be paid, the money will be paid gross to the individual. The agent then takes on the responsibility to deal with the revenue
Right.
and to honour the tax liability.
That's fine. That's even after the NRL1 form is filled in as well.
The NRL1 form is the basis of it.
Okay. So naturally, when you're investing in properties, you're going to have a lot on your books, right? And at the same time, you want to make sure your children get as much of it as possible as well. When you're investing in a property, what are the key implications for inheritance tax, and what can someone do in order to minimize the inheritance tax?
That is something that's quite a big subject. Anybody that's resident or domiciled in the UK, particularly domiciled, will be subject to inheritance tax. And the property, if it's subject in the UK, will be subject to inheritance tax.
What is inheritance tax?
Inheritance tax is a tax basically either on gift or death. Now, gifts within 7 years are not chargeable to tax currently. And I would point out we have a budget that's coming up, so anything I say is subject to the budget. But basically, someone can make a gift, and as long as they live 7 years, it's not subject to inheritance tax. But it starts the clock. And effectively, the clock starts at £325,000. And that resets itself basically every 7 years. Now, the situation there, people don't know when they're going to die, in inverted commas. We deal with a lot of situations where people just drop down dead or they terminal illness and they're suddenly gone. Very often people don't plan for their demise.
Correct.
And the situation there is they don't realise the tax liability that can be inherent on that death. Now, HMRC will value the properties, even if you get them valued for your death purposes, but they will then challenge each one, and sometimes the district value is a bit like Doctor Who. They can go back any point in time to value a property. They don't need to be today, they just do it. And the problem there is, if you don't put the right figures in your inheritance tax return, you can then be penalised for not putting it right.
In the future.
In the future. And the other factor, by putting into inheritance tax, you uplift the value of the property for capital gains.
All right.
Now, the situation, how does one address this? Well, there's lots of ways you might be able to address it. If it's a multi-use property, such as a business involved, there may be a claim for business property relief, which could be up to 100%. That's to be for business purposes. And it's not other people's business, it's your business.
Right.
The other factor here is use of trusts, in inverted commas. We've got a number of clients that use trusts to shelter their property into a trust, which then forms outside of their estate. So that's quite an involved exercise, but it's worth doing, particularly if the numbers are substantial.
Right. And when you say substantial, what is a substantial?
You're probably looking at values of at least £500,000 to £1 million plus.
Above, okay.
Portfolios. Because effectively, you end up in the situation of transfer costs. And there can be exemptions, but basically you need to bear in mind stamp duty and capital gains tax.
Right.
The best thing is to do it from day one when you're starting buying the properties.
Yeah.
You buy them through either a company and then they're owned through a trust. The trust is then owned by a company.
Awesome. So it's bringing it back to what we discussed earlier on.
Sorry,
having
it's the same formula.
Purpose in mind, a goal in mind, and then plan that for the future going forward.
Yeah.
That's
In other
awesome.
words, you have to look where you're going.
Yep.
It's a bit like a road map. In other words, when you look at Google Maps, you put in a place to go to. Well, the same with tax. You've got to say where you want to end up.
Yep.
Okay, fine, things change. We have to change from whether we're playing football or rugby. Governments change. Politicians change their whims.
Yep.
But the point here is the structure has to be set up so it's reasonably sound throughout the period.
Right. So would you say this is one of the main crucial reasons why it's so important to consult a professional
Oh, absolutely.
before you begin your journey in the first place?
Absolutely.
Right.
From the practical point of view, it's a bit like anything. If you, for example, buy a washing machine, it may wash your clothes, but it might not dry them.
Yes.
But the point there is, who can you ask?
Yeah.
In the old days, you may have a bank manager to go and see. Well, I don't know whether they still exist in inverted commas, but they probably don't have the time to talk to you
Right.
and understand the tax implications. So a qualified accountant is essential to bring on, even if it's just to have a call by, to be able to call upon.
Yeah. Let's say we've got a person, right, has about £500,000 worth of assets, right? He dies 6 months after he's transferred the assets to his children.
Right, well, in that case, they wouldn't get any relief, but they would start the process. The process is up to about 5 years. They start to reduce down the amount of inheritance tax.
Okay, so it's like a yearly reduction, right?
It's more or less a yearly reduction, yes.
Okay, that's fine.
So it starts to each it away. So in other words, if someone's in their late 70s and say, look, okay, fine, I'm quite happy to release these over to my kids. Well, okay, fine, you start doing the transfers now, hoping they last for 7 years. If they don't, you can take insurance out to cover that. It's only on the risk cover. But it's then paid by the individuals. It's not paid by the estate.
Right, I see what you mean. And what if someone demise is after 7 years and 6 months?
That's okay. Fine, no problem. No.
Andrew, that was really beneficial, and I appreciate the time that you've taken today as well. I hope that's given you guys a good insight into how you can minimize your taxes as well, and it's also giving you a better understanding of planning your taxation before you actually step into this journey in the first place. Andrew, if someone wants to contact yourself or get in touch with you, what's the best way?
Best way is to contact me. My email address is andrew@davisllp.co.uk, or you can look me up on the website or vouch for. I'm there, and I've got reviews, etc.
That's awesome. Andrew, appreciate your time.
No problems.
Thank you.